Meanwhile, Citigroup announcing it will cut 20,000 jobs as part of a dramatic restructuring to try to turn around the company and bolster the bank's stock. It's the latest in a string of corporations making cuts this week, from nearly 1,000 jobs at Google, hundreds at Amazon, and today, Universal Music. It's given us flashbacks of 2023 and the year of efficiency, coined, of course, by Meta's Mark Zuckerberg. But what does this trend say about the health of the economy? Let's ask LinkedIn's senior economist, Corey Kentenga. Corey, it's good to see you. So these headlines keep coming, Corey. So Citi and Google and Amazon, I don't know. Should we get nervous here, Corey?
Well, there's two things we need to keep in mind when we see these headlines about layoffs. One, like a lot of things in the U.S. economy, layoffs are seasonal. They primarily happen in January. In the information sector, according to the Bureau of Labor Statistics data, and the information sector is very tech-heavy. That's also something to remember. So in this tech-heavy information sector, the layoff rate's about 50% higher in January than any month during the year. So layoffs are seasonal. It's not surprising to see a lot of layoff announcements in January. The second thing to keep in mind is that overall, when we look at the data, both at LinkedIn and the Bureau of Labor Statistics, the labor market seems pretty steady and stable. We're seeing that hiring is actually up in December, and we've seen the lowest decrease compared to last year in December in LinkedIn data than we've seen in over 12 months.
We've also seen a lot of action reshuffling in the media industry broadly. We've seen mergers and acquisitions, and of course, layoffs are part of that. What have we seen inside media?
So in media, actually from December, we're seeing media is actually one of the weaker sectors that we've seen. But in general, media tends to not be too extreme in terms of being down, way down year over year compared to tech, to places like tech, professional services. So media is down in December, but there aren't really any signs that media is doing particularly poorly compared to other sectors.
Corey, can I go back to tech for a second? I want to bounce one kind of argument I've heard about that. And the argument goes like this. It's that these big tech names, they've been putting a lot of time and money and effort into AI, Corey. Meanwhile, of course, they don't really expect to generate meaningful revenue off AI for some time. So to preserve margins, so the argument goes, they're laying off folks. What do you make of that? Does it sound reasonable to you?
So in tech, we're actually seeing the labor market stabilize. Hiring in tech is actually up about 12% compared to July. So we did see a big correction in tech in the last year and a half. They went on a hiring spree during the Great Reshuffle. So they've definitely adjusted. They've tried to adjust their hiring needs, adjust the size of their labor force. But we're starting to see tech is still hiring. And we hear a lot of headlines about really big companies. But what we've seen at LinkedIn is that it's really been a lot of small companies in tech that have kept that sector going. Small companies have been out hiring a bit more than larger companies as of late. So tech is still going in terms of hiring. We have seen places adjust their hiring needs, but tech is continuing to start to hire again. And as I said, tech is up about 12% in terms of their pace of hiring in December compared to July.
You know, I imagine at LinkedIn you have quite the window into the United States job market. Any special insights, anything that stands out that you might have seen in a survey, searches, things people are looking for, just anything that might be particular to your company's offerings, your platform?
So you mentioned AI. So we actually have surveyed executives about AI. What are their plans? Do they plan to reduce headcount? What changes are they going to make? We actually see there aren't really a lot of folks saying that they're going to change their headcount or make massive reductions as a result of AI. Lots of folks are excited about it, but there aren't really many changes on the horizon. Only about 4% of execs said they plan headcount reductions. What we do see, however, is that for job seekers, they're actually very interested to know what companies' AI strategies are. So if you're a company that's talking about AI in the job description, whether or not the job is AI, you're more likely to get views from members. So members are interested. It's a big hot topic right now. They want to know what companies are doing and how that will affect them if they decide to join.
And Corey, you know, you're an economist, so just beyond just LinkedIn, your company, I'm interested to get kind of your broader take on the U.S. labor market. It looks sturdy right now, Corey, you know, sub 4% unemployment, wage growth, strong. How do you see kind of the labor market evolving over 2024?
So right now the labor market is steady. We've posted solid job payroll growth. We've also have unemployment below 4%, but the jobs report also shows certain vulnerabilities, right? There's wage growth, for example, to look at. We're not seeing much growth in labor supply. That makes it harder to contain wage growth. And that's an important piece of the puzzle from the Fed's perspective for getting inflation down to their 2% target. So we see some vulnerabilities in the jobs report. We also see some solid numbers in the jobs report. So it's just something we need to keep an eye on. Going forward, we do expect the labor market to be steady for the first half of the year. If we start to see Fed cuts happening in the summer or possibly earlier, as early as March, we could see a little bit more momentum injected into the labor market. But right now, there isn't really any shoe that's about to drop for the labor market that we can see in the 6 months ahead.
All right. So real quick then, what do you expect the Fed to do this year? If not cutting in March, do you see them cutting later on in the year?
I would expect to see the Fed cut rates at least by the summer, partly because they really want to get ahead of the curve. There's probably some tightening still in the pipeline coming from the Federal Reserve. So they're going to want to get ahead of the curve and start to relax some of that tightening that's already been injected in the economy that hasn't quite come to peak yet.
All right. Really appreciate what you have to say here. Corey Kentanga, thank you.
Thank you.